Imagine this. You wake up tomorrow, check your bank account, and nothing has magically changed. Your paycheck is still average. Your bills are still waiting. Rent, groceries, fuel, insurance, everything is exactly the same. Then you open YouTube and see another video titled, How I Became a Millionaire Before 30, where you turn $500 into $1 million. For a moment, you wonder if becoming wealthy is only possible for people who already earn six figures or come from wealthy families. But here's something most people never realize. The biggest obstacle to becoming a millionaire isn't earning an average salary. It's believing that an average salary makes becoming a millionaire impossible. If you study people who quietly built million-dollar portfolios, you'll notice something surprising. Many of them didn't start with high-paying jobs. They started with ordinary incomes, ordinary lives, and one extraordinary habit: consistency. In this video, I'm going to show you exactly how someone earning an average salary can realistically build a $1 million portfolio. Not with gambling, not with crypto hype, and definitely not with get-rich-quick schemes, but with a strategy that's simple enough to follow and powerful enough to actually work. Let's begin with the biggest myth. Most people think you need to earn $1 million before you can become a millionaire. That isn't true. Wealth isn't built only by how much you earn. It's built by how much you keep and how long you allow it to grow. Think about planting a tree. During the first few years, it barely looks like anything is happening. You water it, protect it, and take care of it every single day, but it still looks small. What you don't see is that underneath the ground, the roots are expanding. Those roots are preparing the tree for years of future growth. Investing works exactly the same way. In the beginning, progress feels slow. Sometimes it even feels like nothing is happening at all. But as time passes, your money begins earning returns, and then those returns begin earning returns of their own. That's when wealth starts accelerating, and that's the power of compounding. Now let's talk about income. If you earn an average salary, your first goal shouldn't be finding the perfect investment. Your first goal should be increasing the amount you can invest every month. Imagine two people who both earn the same salary. The first person spends almost everything they make. Every raise leads to a better car, a more expensive phone, nicer clothes, and bigger monthly expenses. The second person earns the exact same income, but invests a portion of every paycheck before spending anything else. 20 years later, the difference between them isn't a few $1,000s, it's hundreds of thousands of dollars. Income matters, but financial habits matter even more. This brings us to one of the most important rules in personal finance. Pay yourself first. Most people pay everyone else before they pay themselves. They pay rent, bills, subscriptions, restaurants, shopping, and entertainment. Then they look at what's left over for investing, and most months there's almost nothing left. Instead, reverse the order. The moment your paycheck arrives, automatically move a percentage into your investment account. Whether it's 10%, 15%, or even 20%, treat investing like any other bill that must be paid. When investing becomes automatic, your emotions stop controlling your financial decisions, and consistency becomes much easier. Now here's another mistake that keeps people from building wealth. They think they need to find the next Apple, the next Tesla, or the next company that's going to increase 10 times in value. The reality is much simpler. History has shown that broad index funds have consistently rewarded patient investors over long periods. Instead of betting on one company, you're investing in hundreds of companies at once. If one business struggles, others continue growing. This reduces your risk while allowing your portfolio to benefit from the overall growth of the economy. Simple doesn't mean ineffective. In investing, simple often beats complicated. Of course, no discussion about investing would be complete without talking about market crashes. Sooner or later, the market will fall. News headlines will become negative. Social media will tell you that everything is collapsing. Many people panic and sell their investments because they believe the market will never recover. But experienced investors see these moments differently. They understand that falling prices are temporary. Imagine your favorite store announces a huge sale where everything is 30% cheaper. Most people would be excited to buy more. Yet when the stock market goes on sale, many people become afraid. That's because emotions often overpower logic. If your investment timeline is measured in decades instead of weeks, market crashes become opportunities instead of disasters. Another habit shared by successful investors is that they don't try to time the market. Nobody consistently knows when prices will reach the top or the bottom. Even professional fund managers struggle to predict short-term market movements. Instead of waiting for the perfect moment, successful investors buy consistently every single month. Whether the market is high or low, they continue investing. This strategy removes stress, eliminates guesswork, and allows compounding to work over time. Let's look at some simple numbers. Suppose you invest $600 every month into a diversified portfolio. Over the years, your investments continue growing. As your career progresses, your salary increases too. Instead of spending every raise, you increase your monthly investments. Maybe you start investing $700 each month, then $900, then with $200. These increases don't feel life-changing in the moment, but over 20 or 30 years, they can add hundreds of thousands of dollars to your final portfolio. This is why becoming wealthy rarely depends on one brilliant financial decision. It depends on hundreds of smart decisions repeated consistently over a long period. Now let's talk about one of the biggest enemies of wealth, lifestyle inflation. This happens when every increase in income immediately leads to higher spending. You get promoted, so you upgrade your apartment. You buy a newer car, a more expensive phone, and start taking bigger vacations. Before long, you're earning more money than ever before, but you're still living paycheck to paycheck. The solution is simple. Every time you receive a raise, commit to investing at least half of it. This allows your lifestyle to improve while ensuring your future wealth grows even faster. Finally, imagine two versions of yourself. One version keeps waiting for the perfect time to start investing. They tell themselves they'll begin next year, after another raise, after paying off more bills, or after the economy improves. The other version starts today. Maybe it's only $100 each month. Maybe it's $300. Maybe it's $500. The exact amount doesn't matter nearly as much as building the habit. Every year you delay investing, you're not just losing money, you're losing time. And time is the one thing no investor can ever get back. So if your goal is building a $1 million portfolio on an average salary, remember these 5 principles. Increase your income whenever possible. Invest automatically before spending. Choose simple long-term investments like diversified index funds. Ignore short-term market noise and stay consistent for years. Because here's the truth. Millionaires aren't always the people with the highest salaries. More often, they're the people who kept investing long after everyone else gave up. Your future wealth won't be decided by what happens this week or even this year. It will be decided by the financial habits you repeat month after month, year after year. The real question isn't whether someone with an average salary can become a millionaire. The real question is whether you'll start building that future with your very next paycheck. If this video helped you think differently about money, make sure to subscribe.